Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, ANITA FINLEY.
Well, this may be your lucky day. No, we're not going to go out gambling. We're going to go and talk to someone that doesn't gamble because he is a safe money advisor. It's Mike Trombino. He's the owner of Key Financial Group. And if you see his advertising in Boomer Times, it really catches you because it says highest certificates of deposit rates in the country. How do you do that, Mike?
Well, a little-known area of the market for certificates of deposit. Most people are used to those simple Treasury-related interest rates of a half a point for a year to three-quarters of a point. Now the rates are up that high, if you can imagine that. And long-term out 5 years, maybe close to 2% for most of the financial institutions around the country. But there's a little-known area of the market, which is called the market-linked CDs, or certificates of deposit, which are FDIC insured and guaranteed, and pay a higher interest rate than you would earn at your local bank.
Well, everyone wants to know. Yes, you're right. When you first said the CDs, I thought, that's not a lot of fun. But it's good that you've been in the business for a long time. Mike is really from South Florida, and he has a big history in finance and insurance, and you said you had a law degree.
Yes.
So that makes you someone that really can understand what's going on. When did you realize that all this money that we used to get from CDs was going down the tubes? It wasn't going to happen anymore.
Well, over the last 5 or 6 years, we've seen interest rates drop, and really over the last decade, interest rates have dropped to historic lows now, and that's really affected the not only the baby boomers at that end, but also the population of people that are used to depression babies, I call them. They're used to saving money in very conservative manner, relying on the banks for their income and investing the money and earning. At one time or another, you could earn double digits in certificates of deposit. And I still have clients that come in, they're in their 80s and early 90s, and they always reminisce about those days. And now, unfortunately, we're sitting at historic lows, and we'll probably be in this area for quite some time. At least that's what most of the experts believe. So it's been a real challenge for people of that age to live off their assets, and they're actually, eating into their principal. So there's other alternatives out there that don't have the kind of risk that the stock market does, or mutual funds. Unfortunately, for most people I see that are over the age of 75 or 80, they still have most of their money in the stock market or mutual fund market and taking a lot of risk with those funds. But there are some alternatives that offer a better rate of return than they would receive in current CD rates, maybe not as high as what would earn in the stock market or mutual fund market, but there's no risk to your principal or interest, and your nest egg is in place years to come.
It's funny you should mention this because I have a lot of friends who are baby boomers, and they've worked for big companies, and now their 401ks are not doing what they're supposed to do, and that's their biggest problem. They say, I got to do something about this because I've been into my principal, and this isn't going to work. So what do you say to someone like that?
Well, they don't have to use their principal with their investments, and they don't have to take the kind of what I would consider casino-style risk that they're taking by being in the stock market or the mutual fund market. Nobody can predict when that market is going to correct itself, and the market timing is very difficult. I don't believe there's many people out there that can actually time the market. So my suggestion would be to look at some other safe alternatives. One of the safest alternatives would be looking at fixed annuities, which are just contracts with insurance companies that pay a guaranteed rate of return. And we're dealing with insurance companies that have been around for hundreds of years. And they take your money, they invest it, they take the risk, and they pay you back a fixed return, which has always been better than what you would earn in a certificate of deposit even years ago. So currently, some of the certificate of deposits that are paying 2 or 3% over 6 or 7 years, we have an alternative with fixed annuities, where some of these annuities for a 5-year term are paying as high as 3.5%. That's at the short end. And those are great alternatives. These companies pay that contractual rate to you. There's no risk to your principal. The interest is fixed, and the assets are backed by the financial ability, the paying ability of the insurance companies. The other alternative would be market-linked CDs, and those are investments whereby some large banks invest your money, and they pay you a percentage of the return on the investment.
I haven't heard about that, but let me tell everybody who is speaking. It's Mike Trombino, and he is the owner of Key Financial Group. And let me give you a phone number. If you want to talk to Mike, you want him to send you some information, you want an appointment, you call him at 855-661-7233. That's 855-661-7233. And the best thing to do is to sit with someone like Mike. I'm sure he'll tell you what to bring, and just listen. And if it sounds good, then go ahead and do it. Now, go back to what you were saying, the fixed annuities. Is that for everyone, though? I mean, there are always pros and cons of things. What are the pros and cons?
Well, sure. The cons are that the money is placed and deposited away for a while, where there's a 5-year or 10-year time frame that you invest your funds. There is the ability, though, to have liquidity with those accounts, where you can take out 10 or 15% free withdrawal, including principal and interest each year. So that allows you that type of liquidity. But I advise people only put away that amount of money that they don't need as an emergency fund. So if you don't have an emergency fund, then money in an emergency fund would be money market or regular checkings or savings accounts, so you can readily access it. A number of advisors out there, and they're usually in the market, and they're offering stocks or mutual funds, and that's predominantly what we hear over the radios and on TV and in the media. It's all about the stock market, and everybody is supposed to be involved with it. So those advisors are always talking in a negative manner against the annuity, saying, well, your money's tied up and you don't have access to it. Well, that's really not that true. You can also ladder your funds. There are some annuities that pay 1 or 1.5% for a year. So a year goes by pretty quickly. You can have funds there, and in 2 years, there's some annuities that pay 2%. And then 3 years, 4 years, you can go as long as 5 years or even 10 years. And then we have some annuities that are indexed annuities. So they track an index or indice, such as the S&P 500 or Dow Jones. And those are usually longer-term products. They pay based on the market fluctuation, but they pay a cap, and that might be 4, 5, or 6%, which would be the most you'd make. But the rest of the return would be to the insurance company. And the low end of it would be a guaranteed rate or a flat rate of 1%. So I tell people, put some of your funds away that you're investing long-term anyway. If you're investing in CDs or you're investing in stocks or investing in mutual funds, the shorter term you go, the more risk you take. But you invest your money long-term and you continue to put that part of your assets in a long-term investment, annuities have a place for part of your portfolio, not all, but for part of it. Also, there are annuities that pay an income to you. So if you want an income stream, there are plenty of annuities out there that will take your funds and pay you a prorated amount of money for the rest of your life.
Now I know why you call yourself a safe money advisor. I haven't heard that before until you said that to me. When you kept saying, I said an estate money, you said, no, it's a safe money.
Safe money advisor.
I know it's...
Yeah, I don't want people... When people come to my office, they'll know one thing: they won't lose any money. The products like the market-linked CDs I had mentioned to you before are backed by the Federal Deposit Insurance Corporation, the FDIC, and those products are a little bit longer term. They can go from 5 to 7 to 8 year windows, and those funds are invested over and over again each year. And I have one fund that I've been advertising that has averaged since 2003 7.5% a year. That's close to what you would see in the market rate of returns. And if you hold it to maturity, you'll have principal guaranteed plus whatever interest you earn in the meantime. And the least amount of interest you would earn on an annual basis is 0.75 of a point. The most is no cap. And one of the companies I work with, one of the banks, large bank, has no cap on the return. And one of the years it did over 22%. And when people hear that, they don't believe it. So unless they come in and see the offerings and see what we have available and have it explained to them, then they won't find out about it. Then they'll just think it's too good to be true and decide not to even consider it.
What is the minimum amount of money that someone must deposit to get something like that?
That's $25,000, and that's my company's minimum. $25,000 to come into the office to open an actual account. People come in with larger sums of money, and I do look at a number of different ways that we can diversify their safe money. But a lot of people now are leaving the stock market because they've made a lot of money over the last several years, and now they're afraid of the risk of the correction, and they don't want to be part of it. So by placing their money in safe fixed accounts and also accounts that have indexed rates of return, they have that protection. They don't have to ever worry about their principal being lost, and they have access to those funds on an ongoing basis.
And where is your office, or do you go to see them in their homes? How do you work this out?
I do sometimes meet with people in their homes if they can't get out and about, and I do have offices, 2 locations, but my main location is at 8461 Lake Worth Road in Lake Worth, Florida. That is at the Crexon Business Center, just on the west side of the turnpike and north side of the road, and that's easy to get to off the turnpike. The other office I have is in Vista Parkway off Jog and Okeechobee, and but I do come to people's homes too, usually after they become a client.
That's great. Oh, sometimes that's important. So it sounds better. This sounds like I heard someone say the other day, well, there's no point in putting it in the bank. So I'm not getting any interest. I'm just going to put it under my mattress. Do people really do that?
I wouldn't put it under my mattress. With the crime rate in Florida, I'd hate to be robbed and have robbers go under my mattress. That's probably the first place they would look, right?
That and in the freezer.
Or the freezer, I guess.
Of course, it is funny because I'm a gerontologist and I do know so much about the aging population. And many people, of course, hide their money, but then they die and they have never told anyone where it is. And their kids, sometimes sell the apartment and the money's just somewhere, but no one knows where. So it's better.
That happened to a very famous gentleman by the name of Rocky Marciano.
Really?
He was a professional prize-fighting boxer back in the 50s and 40s and 50s, and he was a patient of my father's. My father was a physician down in South Florida, and his family was. But when he died in 1969 in an untimely death in a plane accident, his wife had a very difficult time finding out where his money was. He didn't keep it in the bank. He didn't trust banks, and he hid it in places. I don't believe they really recovered most of the funds that he had. It was worth several $1 million. And, it was terrible what happened.
It's quite a story.
Yeah, well, that was in the press too years ago.
I'd say so. I remember Rocky Marciano, but well, you're doing such a great job. Do you want to continue?
That's fine.
You have time? Okay, we can keep going. Sure. So, but that's a very funny story. But it's not funny when people do things. I mean, I probably hide $1,000 somewhere, but I'd never tell my husband knows where it is. But you're right. If something happened to us, it would be $1,000 less. But I don't know why we do that.
Are you telling me the truth?
Yeah, I am telling you.
Your husband knows. No,
he knows. He knows. No, he knows. Well, we just put it somewhere. I don't know, in a shoe or something. And it's not really what it's really for. Is that in case you've run out of money and it's the holiday and you didn't get your money. That's what I do it for. I don't do it for anything else. But it sounds like you're in a perfect place now for our population here in South Florida, because you're right. They don't know what to do. They thought they were going to live on their earnings, and they're really afraid. And the kids now, they can't support them. I have some friends who are trying to support their family members, and they can't do that with their families too. So I think you have a very, very good responsibility. It's an important responsibility. So let me give your name again, and so everybody will listen. Remember, I'm Anita Finley. You're listening to the Boomer Time Show, and we're talking with Mike Trombino, who is owner of Key Financial Group. It's his website is very interesting. It's the smartmoneyinvestor.com. thesmartmoneyinvestor.com. And he does have a lot of experience in the life and viatical settlement industry. He has he deals in Central and South America, United States, and Europe. He's licensed in Florida, North Carolina, and South Carolina. He specializes, I guess, in helping seniors pre and post retirement. So if you're listening and you've already retired, go stop in, talk to him, see what he says. There's no responsibility. On your part, you don't have to pay him anything, and you probably should pay him for a consultation, but he's not going to charge you anything. He's going to do such a good job that you're probably going to give him some of your money to invest and do it properly, since he is a safe money advisor. And he is located in Lake Worth, but if you're in a situation you can't get there, he probably will call, make an appointment. But this is his phone number. Get your pencils out. Remember, this is Pencil Talk Radio. It's 855-661-7233. And I'll do that again. 855-661-7233. And I like what you said, that a lot of your products are FDIC insured and guaranteed. That's pretty good.
Yes, they are. That's great. And then the insurance products are guaranteed by the insurance companies. And we deal with just about the highest rated companies we can. I represent a number of different companies all around the United States. And I help those clients choose the best product for them.
Mm-hmm. And people do need to have an expert to help them. So many people think that they can take it on. Now with the internet, they get on there, they get fooled. That's not their business, and they shouldn't be doing that. But they listen to someone around the pool that they just got this or they got that. But, to diversify is what we always tell people who are over the age of at least 60. If you don't expect to be able to work anymore, or you may have to go back to work because your investments didn't do what you thought, but you really can't have everything in one place. And I think we've seen this over the last few years. So I'm glad that you're doing this for people. And so you said before you grew up in South Florida, you said that your father was a physician here. So are your parents still alive?
No, they aren't. My father died years and years ago.
Huh. But, we do have a lot of family members. My mother passed away about 10 years ago, but I grew up in South Florida also. I actually went to Beach High, graduated from my Beach High School. But I do remember so much that my grandmother, my mother and her sisters took care of my grandmothers because my grandmother didn't have any money, and their investments helped my grandmother. But they're all passed away now, and so that's who they have to look to, their families. Well, just ask their families. I have a son who's an attorney in Miami, and they have 9-year-old triplet children. So how are they going to be able to help?
Yeah, it would be hard for them, right?
It is. Well, they are helping some other family members. They do it, but it's not right. So if people could go talk to you, at least put some of their money. They don't have to put it all, but just have you advise them and do some of these things. The indexed annuity sounds good, but it's maybe not for everybody. It depends on their age, doesn't it? How do you deal with that? Talk about the age situation.
Well, the age factor. With a number of the accounts, the insurance companies, and of course by state law too. Florida's a highly regulated state when it comes to these types of products too, and they're very stringent. We have to fill out suitability forms. We have to make sure that the client is suitable for the investment, and that deals with age and mental capabilities too. And we have to understand that they understand the circumstances and the product itself, so we explain that in detail. We have full disclosure on all these products. We're required by state law. But based on the age, a lot of companies limit the type of investment and the term of the investment that the person can make. The indexed annuities are usually for people 80 years or younger, but there are some companies that are approved products in the state of Florida that have some higher liquidity features that allow people up to age 85 to be an index product, which tracks an index or indices. As far as the fixed annuities, there are a few companies out there that allow investors up to age 90 to invest in those products, and some even up to age 100. Very few, though. And those are usually short-term annuities. People feel annuities are long-term products, so they fear the annuity because there's one of the annuities out there that a lot of stockbrokers offer on brokerage firms are variable annuities, and those are invested in the stock market. and your money is totally at risk. And if the market swings down, your principal drops also, and you could lose money in those. They do usually have high fees also with those products, management fees. Whereas with an indexed annuity, it allows you to have participate in the S&P 500 is one of the indices. If the S&P is up, you're able to capture some of the gains in the S&P, but there's usually a cap put on those. 4 or 5 or 6% is the most you can earn on an annual basis. And those accounts are for people that are a little bit younger. But those do not have any fees in the indexed annuities. There are no fees in the fixed annuities either. Unless there are some, they're clearly explained. Very, very few of them have any type of management fee or fee at all with them, and they don't have the risk that a variable annuity would have.
So how are they paid for? So how do you earn your money? I mean, is it inside the payment, or is it at the end, or the?
Well, each on an annual basis. Sometimes every 2 years, they would look at the S&P based on when you entered the market, and if the S&P earned 11 or 12%, they might have a cap on it. So the cap would be, say, 4%. So from 1 year time frame, a 2 year time frame, if the performance was positive above zero, you would get whatever that performance is up to the cap. As an example, if the cap was 4, the most you would make is 4. If the S&P earned 10% that year, you'd only get 4. If the S&P earned 2%, you would
still get 4. Oh,
yeah,
okay.
Get 2. You get 2.
I see.
The 4% is the most you would earn. It would be the cap. So any performance above that, you would not participate in.
Oh, I understand. So everyone's taking a little bit of a chance.
Sure. And then every year, if there's a negative performance in the S&P 500 and the account that you own, you would get a 0. You wouldn't make anything that year, but everything that you captured as far as gains from the prior years would be secured. So,
I see.
And then not all your money has to be in the S&P. You could diversify. There are some that allow you to have a fixed rate of return. Some of the fixed rates are as high as 1.5% a year. And some of my clients are very conservative. They put half their money in the S&P side of it and half their money in the fixed side of it. And they end up having fairly decent returns, but not stock market returns. But one thing for sure, they don't lose their principal. Their principal's secured, and they capture all the gains in the market, which over time they grow their money long term, and on a tax-deferred basis, they have pretty much triple compound interest on their funds. So I look at people who walk in my office with an account that's worth $100,000, and they want to move it out of the mutual fund market. And then when I look at their initial statement, they started out with $160,000. So the market affected them that way, and that happened a lot in 2008. I had plenty of people that came into my office with negative returns in their accounts, and they wanted to secure those funds in something safe. So these are the alternatives that I propose.
You sound like you really like this. I get the feeling you're very enthusiastic and that you like making people happy and that you like fooling around in this business. You're not fooling around, but working in this business. I can always tell from somebody's voice. And so
I really enjoy it.
Yeah, I know. I can hear that. And so you're in the right business actually right now, especially because people do need help. I mean, they just listen to the wrong people. And, there for a while, I remember, it's not to do with you, but like with the market, that we had people who were pushing day trading. They hadn't the faintest idea. Oh, my friend made a lot of money in it. Oh, I'm going to do it. I know so much. And I kept saying, you have to be very careful with it. Oh, no, I'm going to do it. And they wound up losing a lot of money.
Sure. Well, I tell you, I have clients that have their money on the side. I don't talk to them about their securities, their stocks, bonds, or mutual funds. They can do what they want with those. I advise them, really realistically look at what risk you're taking, and can you afford, like you say, if you're not working anymore, you're retired, can you afford to lose any part of those assets? My first question to most people, and usually their statement is they can't. But they take some money and they go and day trade. I have a number of clients that do that, and the wife and husband, when they come in, the husband's the day trader, and the wife will always say, "Well, you're not really doing that well." It's kind of like when you go to the casino or the horse races, which I do neither. And you only hear about people's wins, not never saying about when they lose.
Oh, true.
And I don't think the casino business would be as profitable as it was if they were losing money, right?
Oh, that's so true. You really said it the right way. That They don't tell you. Just like, that's right, even with stocks. You're right, stocks or other things. But people don't typically talk about their annuities or any of the CDs. I mean, they just, unless they're doing very badly. But I like how we started off with this, that you have CDs that do much better than that 1% if they're lucky. So you have, I see here, a certificate deposit can earn an average of 7.5% each year. That's pretty good. And it's just a minimum of $25,000, and you can put someone into that?
Yes.
Huh. Interesting. And that could be, what, for about 10 years?
These are usually anywhere from 5 to 8 years. And the key there is the interest would be paid out every year. Whatever interest they earn.
Really?
They would be paid on an annual basis. It's taxed as ordinary income. So it's, it's not like, if your capital gain. But the alternative would be you can stay at the bank and earn 0.5%. I have people, I'm surprised, they're mad. They come in upset and really upset, but they're so used to going back to the bank, and the brick and mortar bank and the banker and the free coffee, I guess, makes them feel comfortable because they've been doing it for years.
Yeah.
And they are afraid to even step into this market sometimes. And it's not for everybody, of course. You have to invest your money and deposit it for long term because it's not liquid until the 8 years is up. It's an 8-year maturity on these. So kind of like an annuity the same way. You have to realize they pay the interest when it's earned. If you have a negative year, and this one account that I have, it had a negative year and back in 2004, but the rate of return they paid, they had a guaranteed rate of 0.75 points. So even in a negative year, they would still pay you, the bank would still pay you that 0.75 point. So you really don't lose the money. You're guaranteed a fixed rate. Sometimes it's only 0.5 point on some of these accounts. So every single year, if the market was down in that portfolio, you would at least get a 0.5% paid out annually to you. That's kind of what you're getting in a 1-year CD today. But with a 1-year CD today, the standard CD, you don't have any possibility of making more than 0.5%. And this account, you're able to make, in some cases, a cap involved. You might make up to 4 or 5 or 6%, depending on the cap they put on it.
Well, Mike, it's been terrific. I hope next time maybe you'll come into the show and we can do this again. But I want everyone to know you've been listening to Mike Trombino, who's owner of Key Financial Group, and the phone number to call is 855-661-7233. That's 855-661-7233. And you can get on the web, thesmartmoneyinvestor.com. Thank you so much. It was a great interview.
Oh, thank you.
All right, bye, Mike. Okay, thank you. You too, bye.